Dzień dobry Państwu.
Morning, ladies and gentlemen. The panel will be in English. 2 words in Polish for me.
Be here. It's my third year in a row moderating a panel, and I'm very glad that I will be able to welcome and discuss some important issues with real experts in the fields and good friends of the Polish capital markets and of our conference. But let's take a look at the last year. So exactly a year ago, we had the Warsaw Passive Investment Conference number 5. On the 24th of April 2004, we are here. The years passed, and what a year it was from the perspective of what happened in the capital markets, also in the passive investment sector. So it's a year that had it all. What we had is the inflation that refused to ease. In Poland, still close to 5%. Fingers crossed for it changing. Well, obviously, the geopolitical tensions that also refused to fade away. And then, even more interestingly, we've got the Liberation Day not long ago in the US, not quite liberating. We all know what happened. The markets tumbled, then shook, then bounced, and then rebounced. And in terms of our indices, they made up very easily all they've lost. And we are very happy and proud to say that the Polish indices, even though we don't have the 100,000 points yet, are one of the best performers in the whole world. So that makes us proud. And what is more, in terms of capital, it moved quite significantly from bonds to equities and bounced a little bit. Also, growth stocks and growth indices and growth ETFs were very popular last year. We see a little bit of a shift towards value for obvious reasons. And when it comes to thematics, well, uranium, super popular, lots of inflows, performance not so impressive in the last year. AI, still quite a hype. We've seen that being spoken a lot, but we don't really see it that much in terms of inflows or performance of the AI-based funds, but I'd like to confirm that with my panelists. Well, gold shining bright, all-time highs, and doesn't seem to be giving up at all. A year ago here, lots of our conference participants would have said S&P 500, the way it is probably a no-brainer. Today, does this hold true? Or not so much. In the ETF space, we see a strong shift towards equal-weighted American indices and exposures. So lots of things happened from the perspective of the passive investor and the ETFs as well. It's my great honor and pleasure to discuss that with real experts in the field and great friends of the Polish capital markets. So let me welcome on stage Andrzej Wonia of Han ETF, Tomasz Packa of DWS, and Markus Poscher representing Invesco. It's a pleasure having you here, and thanks again for being great friends and supporters of the conference and of our capital markets. Always happy to see you in Warsaw as well today. I'd like to do a couple of rounds of questions. I hope we don't agree on everything all the time, not to make it boring. I'll try to stimulate that, and since the topic is super hot, let's try to leave a couple of minutes for the questions from the audience. Why not starting with Trump? And considering I more or less hope I know what products you're offering. Why don't we start with the American exposures, and then you, Marcus, and Thomas, and Andre, to complement that with your perspective. Okay, so Marcus, Liberation Day, we all know what happened. How did it look like from the perspective of the assets that you manage and your investors? What was the practical reactions? Did you see lots of outflows? Not necessarily.
Well, thank you very much. I guess it's the topic of the day, and to be honest, going forward, I guess nobody really has the answer how this will unravel in the next couple of days and weeks. To answer your question, obviously there's been a risk-off mode that we've seen in markets, that we've seen in ETF flows in particular. Obviously, just in UCITS, there's several billions of redemptions in US equity ETFs going into European ETFs, so there is some reaction. The question is, it's still just a fraction of the assets that are in there. Is this a temporary shift? Was this just getting a little bit more risk view on US assets, or is it more permanent and more lasting damage that's been done to the US market in general? And I think the answer is out there. Nobody of us can really tell. What we've seen is that investors do mitigate the risks. One example you mentioned, we had the presentation on equal weight. Equal weight can be one part of the answer in mitigating somewhat the exposure you are having. But I guess at the moment, it clearly has been a risk-off mode for US equities. The last 2 days have been quite positive. Probably today will be rather negative again, given the news with China again. So at the end of the day, actually, it's maybe as an investor, you can't base any sound investment decisions on the news that's going out day by day now these days. So you have to somewhat look through this. And the answer probably is for an investor, retail as a professional investor as well, to have kind of a more boring portfolio, being diversified across several asset classes, doing equal weight is one example, having a gold exposure, even cryptos, we're coming later on to that topic. So this is kind of probably the way going forward, and looking through that peak of volatility that we're experiencing right now.
Thank you. Yeah, of course, there has to be crypto in every panel in Poland. We love crypto, but I'll go back to that later. Thanks for that. Thomas, what's your view, and did you see investors giving up on US equities and US equity-based ETFs, or not that much? Are they passive investors that bought that ETFs and parked them for 20 years or whatever until retirement? Or did they really get a bit, not to say scared, but uncomfortable with the drawdown of the beginning of April?
Hi all, and thank you very much, Marcin. To come to your question, let me maybe just rephrase it a little bit into the picture where we are right now. And until December of the last year, for a number of years, everything was about US. US was actually the point each and every investor has been looking at and was investing. So it was technology, 6 names, that's all. All the performance has been generated by these these magnificent 7 or 7 companies in the market. What changed? December. December changed a lot. So since January, we have seen kind of a full stop of flows going into the US exposures, and Europe coming back again to the life. So we see Germany really coming alive and getting flows. But why is that the case? I mean, if you look at the US, it's the biggest market of the world, okay? I mean, Mr. Trump is aspiring, making America even greater, but US is 70% of the market cap. How much bigger do they want to get? So Europe has been underrepresented in the portfolios of all of the clients or investors by a big numbers. So it just started, the people are starting to reducing kind of the underweights. So people are coming back to Europe. The flows are coming back to Europe, while the performance is also coming back. So this vision of change in the political sphere. So I think there is more behind that what we see kind of on a daily basis. And nobody can forecast that. to be honest. I mean, just to be able to forecast the upcoming events or on a daily basis expectation for the market, it's not possible. Why? Because what do we live off? Markets live off expectations, security that I know what to expect from the market or from the politics. And no, that's not given right now. So it's completely impossible also for our macro teams to forecast anything. And I think that's the big question mark for the market to solve.
Thank you. Andre, your perspective and product portfolio is obviously a bit different, but also super interesting. And my question would be, considering what's happened in the States, did you see that impacting what your investors are doing, or maybe different parts of your business that are, because you are strongly connected to the US market from a different angle? What's your take?
I do kind of agree a bit, with the view that was said before, that we are potentially seeing a real fundamental shift in the way the markets approach their asset allocation. US is the deepest, most liquid financial market. That's how it evolved and still is. And you see it in many areas. For example, emerging market, which you would think is actually the opposite. It's something outside. It's kind of the other side of the developed markets. But when, as soon as the US started to intervene a couple of years ago in the China discussion and said, oh, maybe we do China tariffs, we don't like, what's happening with Alibaba, blah, 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 and also Trump, suddenly the world started dumping stocks and China and emerging markets suffered. Not because they did something wrong. The market, what US does and says, kind of dominates the markets there. There was one thing, and people were heavily exposed, as you said, to the US. Now, I think, with the election of Mr. Trump the second time, and I'm not making, politics, you can decide whether you think it's good or bad, but I think it was a bit of an aha, awake moment for many people we spoke to say, I think my feeling is many Europeans did not expect the second election. They said, it's not going to happen the second time. Look at Kamala, she's a pretty moderate candidate, good. And she was crushed, right? The US population, with all that happened, all the things around Trump, that for us, as often Europeans, seem a bit, extreme, still happened. We said, okay, maybe this change is for real. Maybe what he says, what's happening there, it's also wanted by the people. It's supported by a large majority. Not everyone, there's people with different views there. But if that is the case, then maybe we need to review our relationship to, also from an investment perspective and political perspective, to how we approach US investment. And you see it in the US dollar devaluating fairly strongly now, fairly quickly. Maybe that is a change that people say we are going out of US assets more broadly into other US assets like Europe. I do think there's a shift. It remains to be seen if it's indeed a long-term structural shift for good, or if it will revert again back to what we have come to see as a normal thing, where US keeps dominating, or whether this will play out over several years now that we have a change. I don't know that, but the discussion we have is clearly going into the structural shift area a bit now.
Yeah, thanks for that. It's really interesting. Though I'm a bit unhappy that you continue to agree on more or less everything. So let's try to tackle it differently. So technically that should move to emerging markets. Okay, so we are very happy, and I hope that Poland will be on the radar a little bit more visible. But then some of the emerging markets, one might have thought, okay, so US is not doing so well, or is a bit too volatile, so let's think of Vietnam or something like regions like that. But their performance is even worse because they got even more hit. Yeah, is that also visible in the emerging markets indices? Let's park Europe for a little while. What do you think, Marcus?
I guess emerging markets in general have been pretty unloved for the last couple of years, China in particular. And the immediate switch out of the US into emerging market did not take place, as you rightly pointed out, just because even some very friendly countries like Vietnam have been massively hit, overproportionally hit by Liberation Day tariffs. So I guess that's, as an investor, a very difficult thing to make your investment, to base your investment decisions on. At the same time, and maybe pivoting a little bit to China being the elephant in the room when it comes to emerging market investing, that there's really a decoupling of China towards other emerging markets, and especially it's been so cheap, it's been rallying quite a bit, and we've seen substantial flows back into China after a couple of years of simply no investments into China. So this is still on the radar. It's still super cheap in whatever matrix you're looking at it. Obviously, nobody can quantify how the tariff war will, play out. The expectations from the last couple of days was more into the sense of, there might be some agreement. Today's news look a little bit different again. So it's kind of on and off. So it's probably difficult to make an investment decision. But we do, as a house, we still do see China as being an interesting place to invest in over the longer term. And you have to look through the volatility of these days, and hopefully we're going to have some more visibility in the near future.
Very interesting. So there's Europe on the radar, China on the radar. What else is there on the radar, Thomas?
Expect the unexpected. It's right now, I think, one of the topics to play. And I think it's time to look at, I think it's kind of love the unloved ones. Really look at the markets that haven't been doing really very well over the last few years, that have really big potential. And I mean, China is one of those, because China is a big player in the meantime. So I mean, just not to look at them, I think it's a big miss. But what else? I mean, for example, small caps. I mean, European small caps could be very interesting. So in terms of just this big infrastructure investments and defense investments, also in Europe, the European small cap industry is very much underrepresented. And that's also kind of showing the picture of this whole discussion, equal weight versus standard market cap based. I mean, the risk premium for European small caps or US small caps haven't been performing any performance or giving any performance for the last 5 years. So this risk premium out of small caps was not existent. Everything was driven by the technology and large cap. It's unusual. Normally, small cap, more risk, you get more money for investing into these kind of companies. That hasn't been happening for a long time. So if this could come back or would come back, I think could be very significant kind of a movement in the market. Emerging markets overall, I mean, it's a different market. Right now the world is being pushed into the direction to find new solutions. Without America, kind of. And I think that's what we are underestimating is the market is flexible. Sure, there's going to be a hit. It's going to be something we need to work with, but the markets are going to find ways to come out even stronger. Also, Europe, we have to rethink. We have been pushed into making some hard decisions we wouldn't have been doing maybe without this Trump intervention. So maybe out of the bat, some really good things come out, and I think the market and the global, I would say, emphasis is going to support that.
Thanks. Andre, is there anything else, or shall we maybe forget equities? I mean, I'll touch upon thematics later, but is there anything, do you agree that it should be the small caps momentum, or not that much? I mean, here in Poland, we are, if you ask like mBank, Bosch, who are partners or sponsors on the conference, the best traded ETFs are usually the most popular one. MSCIs, S&P 500s, and I'm simplifying for the sake of the moment, obviously. So I'm not sure we are here. We would be super happy to switch to small caps and give up on our US exposures. What else have we got? Or would that even make sense?
Exactly. You want me to not agree, so I have to say something that's different.
No, please.
So
not necessarily.
I'm not allowed, so I can't say small. On the emerging market complex that you said, India, I think is very interesting. And I'm saying, I'm partly biased because we do offer, we run an India strategy for a few years. But I generally think, having looked at the topic with our analysts for a while, I think it's what Modi has done in India, the way he's built up the country, not just him, also the interaction between some of the conglomerates, the big guys, the Tatas of this world and whatever, and in India. When it comes to, India is still behind where China was before. So the big question is, can India become the future China? I think India is playing it politically quite smart. Modi has been a jack of all trades. On the one hand, he buys oil from Russia via tankers that are not registered somewhere and whatever. So he's kind of circumventing that. But on the other hand, we say it's the biggest democracy in the world, in caveats, with a couple of caveats at the bottom. He's buddy with Trump, but equally he's okay with the China guy. He's trying to be okay with Europe. So he's playing everywhere. He's doing it smart in a way, very pragmatic. They have a huge population, the biggest in the world by now. And they were not very urbanized and not very tech developed, but that has changed massively recently. They had this introduction of what they call the India stack, which is they basically managed to give hundreds of millions of people within a short time frame a digital passport, because many in India don't even have, you're lacking a birth certificate, ID card. That has changed. They built a digital platform over the last decade, which allowed these people to go into a shop with very simple technological infrastructure and at very low cost. Take a picture, put them in a database, take their fingerprint, I think even an iris scan or something, and suddenly these guys have a digital identity, they can open a bank account, and beyond that, they actually created, because we can do it these days with the technology we have, on top of that, you can build further layers. So once you're in the system, you can build on top of that something like a digital bank account, and you can be connected there. That bank account, the third layer now, is the e-commerce layer. Companies can build stuff on top of that, like applications. So you can suddenly interact on the e-commerce level. Scale that up to 1 billion people fairly fast. It's a huge growth opportunity there, which I think is underappreciated simply because it's so far away for us. I had no idea about this stuff before I started. I had to read up for part of my job. So I'm not saying it's a self-fulfilling prophecy. There will be obstacles to that. But I think watch India. It's a really cool stuff happening there.
Very well. Thank you. Super helpful. So I think we covered more or less regional exposures. And there's been quite an interesting message for the Polish investors, what to consider, if not the US, and let's not be boring and think of something else as well. So why don't we park the regional allocations and discuss products? So the famous equal weighting momentum. Marcus, by the way, I love your presentations in terms of they're super informative. And I remember the ones that you did as Investcos in previous conferences. So is this, like we know, it's not only S&P 500 equal weighted, it's even enhanced equal weighting sometimes. It's like up to 3% of something. Is this just a trend, or do you actually see people and institutional investors maybe in particular switching from the regular S&P 500 and cap-weighted indices into equal-weighted ones? Is there, to phrase it differently, do you see the AUMs confirming the general hype related to the equal-weighted indices?
The short answer is yes, definitely. The longer answer is obviously, and as Chris in the presentation earlier this afternoon pointed out, the way we measure, we construct indices, it's chosen by us, by the index providers, but then used by ETF issuers like ourselves, by investors like yourself. And there's no holy grail why it should be cap weighted as the traditional indices are. There are different methodologies out there. You can discuss pros and cons of each of those methodologies. But what we're clearly seeing is, especially now with the trend and us and some of our peers having also in the usage range now more and more equal weight equity ETFs, that there's definitely a pattern, and definitely we see the flows, couple of billion flows just this year. In the US, we've got the largest S&P 500 equal weight, which is now some $75 billion in size. So that's more than a trend. So I guess we can confirm it's here to stay, and the appeal and the ease for even for retail investors. If you have an S&P or an MSCI World cap-weighted, a traditional one, and you are concerned somewhat about the concentration, about the valuations implied into those big names, you add, according to your risk profile, you add a little bit of the equivalent equal weight strategy. You can have a better overall portfolio, a better risk-adjusted return in that sense. And that's the reason why we firmly believe equal weight is here to stay. It won't replace cap-weighted, for sure not. But it is just another way of still getting exposure to, let's say, to US equities. And that's the point, I guess, also what's been in discussion over here. The US equity market will remain the largest ones, even though it has decreased now quite a bit. It will be an important part of any investment portfolio going forward. And then it's the question how to access this. And equal weight is one option of how to do it in a more, let's say, maybe rational way.
I'll follow up with you. Is it more difficult to replicate equal weighted than, like, I'd imagine for some cap weighted indices that include thousands of companies, those tiny part of the percentage of the 500 companies, the asset manager might say, whatever, I'll just cover that exposure with anything. Apologies for simplifying the asset management business too much, but I mean, is it more difficult to replicate?
No. We're talking here still about the largest S&P 500, largest 500 companies in the US or in MSCI Europe, the largest companies here in Europe. So we're still talking about the most liquid, largest liquid companies out there. So there's no additional complexity. It's rather simpler in that sense, maybe.
Perfect, thank you. So Thomas, so there is a trend. It is there to stay. And I always valued your being very honest here. So my question is, okay, but does it even make sense? Lots of people made a lot of money on the mega caps and cap-weighted indices, and now they're switching to equal-weighted. I mean, isn't it too late? Or for so many years we haven't
I can't
thought about it?
confirm on now. My problem is this now, because it's not happening right now. It has been happening for a long time right now.
All right.
So I mean, you are big in the US, but we are big in Europe. So we are kind of the leader in this space for a long number of years. So for example, the S&P 500 equal-weighted ETFs we have for over 10 years plus. And we see this change in portfolio allocation from the clients going on for the last 1.5 to 2 years. And this is particularly interesting. So it's not happening right now. I see actually right now completely the opposite side. So people are really more or less kind of taking the profits and kind of reallocating back. So over the last 1.5 years, we have seen really significant flows into these equal weight strategies. Why? Because of this huge diversification approach, and the investors didn't have any other tools how to diversify away from these big tech companies. So we have seen investors coming to these equal weight strategies really in a big manner. So I'm speaking about per year like 8 billion inflows, what we have seen here. And the range is around 20-25 billion. So why was that happening? Normally we see flows where the performance is, or kind of when the fund or investment vehicle is outperforming. This was not happening. So equal weight has not been outperforming the S&P for the last 1.5 years. So why did they switch? Or why the flows? Pure risk management. So the market has been unhappy with kind of this very big tech weighting. And that's kind of maybe something to consider. I mean, it has been happening for a long time right now. Now we see more on the outflow side, kind of really the people coming back to the standard market cap, in terms of mean reversion, taking advantage of the lower valuations in the tech space. So let's see where we're heading right now.
Thanks. So equal weighted is let's not call it a trend anymore. A real thing that is there to stay.
It's not a new trend.
Yeah. Well, thanks for that. I think might have been my impression that it's more visible now, but that's very important because you've got the practical insight and you see what people like. But equal weighted is still kind of boring. And Andre, I'm moving towards you because you partnered with recently as Han ETF to introduce a covered called ETF. And I was thinking, like, what other strategies are there for investors to try to do something more interesting and hopefully more profitable than the plain vanilla exposures or being that cap-based or equal-weighted. What else is there product-wise to make an interesting product for the market?
So just very quickly say something maybe hopefully controversial on the equal weight side. Equal weight didn't work out return-wise in the last few years. We have equal weight ones. They sucked. It did not work out. Like we had an equal weight tech one. We talked a lot about it. Investors came in and out. Nasdaq versus equal weight tech, massive underperformance year after year after year. Winner took it all in the tech space. If you tried to go against the Magnificent Seven, you lost out. Active managers were despairing because if you were not invested in those guys, I'm not saying this forever. I think there's a very good academic foundation in equal weight in the past, for decades actually, where you can show mean reversion. Things work. Sometimes it makes sense with things going up fast to rebalance back to normal. So there's a very good reason why people thought or wanted to do, but I think in recent times it just didn't work out very, very well. And there was a lot of disappointment on our side when we speak. We don't have as much exposure as the gentleman here, but we have it in a few funds, and it just didn't work out. It might, maybe again in the future, who knows. What else can you do that's exciting? You can look at new asset classes to find new markets. You know, you can, as an investor, so if you want, or as a product provider, if we want to, when we speak to our partners who give us the ideas, they often try to give you access to something new that didn't exist before. For example, a few years ago, we started offering access to EU carbon allowances, as an example. So you can invest in CO2 emissions. That's an EU regulatory-driven asset class. It was invented roughly 20 years ago, and it was investable via various financial derivative means. But now we had the ability to do it actually in a new way, like a gold DTC, physical. So that was a cool new thing that gives you a decorrelated asset. So if you have a portfolio where you say I want different things, I want equities, I want bonds, and something else, that can add to that. We had the crypto boom. We'll talk, I think, about that a bit later. The crypto is another example of an innovation that comes to market. You can wrap it, you can make it investable. And I think one trend that we are seeing right now is the active ETF development, where in the passive space you have maybe only so many ways to structure, cut and dice and slice your exposure. You know, you can market cap, you can equal weight, you can sector, you can do a sector, you can do a region, and so on. What you can do in the active space is that you can simply go to somebody who thinks they know a certain asset class or a certain sector very well, and they will implement a tailor-made strategy, actively managed, where they underweight stocks or subsectors by themselves, and give them a chance to prove it. I know it's a new idea that for some investors it's like, well, you told me ETFs are passive, and you told me ETFs have to be cheap. Why are you telling me ETFs are doing active management now? There was a bit of a misconception. There was, in the past, ETFs were built to track a passive index. That was the original idea. But there's nothing preventing an ETF, a fund being exchange traded and have an active strategy. And I think we will see more, and there will be a lot of interesting, managers coming with their ideas to market. So that's why you will find what you were talking about, Marcin, this new idea, because it's difficult to sit in a room and come up with new ideas all the time and say, oh, I'm the product issuer. Let other people, let people in the market decide what they think is great. You find a lot of good ideas there, and they will be implemented as active strategies, I think, in the future.
Very much looking forward for new products and ideas, especially the exciting ones. Let's move to thematics. ESG is not fancy anymore, or am I wrong? Uranium did quite well until a point, but still lots of assets under management, I'd imagine. Defense, everybody has a defense fund nowadays, or almost everybody. Quite a strong performance, more or less. AI, it's my impression that lots of people made a lot of money on NVIDIA stocks and things like that, but the funds, not AI-based, not that much. But maybe it's just a wrong perception. What do you think of those three? Let's park gold for a little while. What else is there that would be very interesting in the thematic space market?
You touched on very different strategies, very different sub-asset classes, very different thematic approaches, which all have their fundamental line of why it makes sense, why it's rational to invest in those sectors, be it AI, be it defense, and so on. It's really then down to investors to decide if they see some of those long-term trends really being here for longer, if it's just the beginning, like we had this afternoon, presentation on AI, if it's just the early stages or not. There's no answer out there. None of us can tell you really if that's just the beginning or the hype is behind us. So that's kind of where you as an investor need to make up your mind which of the themes you really think are out there. It's then back to the investor in that sense. Much of them has been played, by using just broadly risk-on trades, on using a Nasdaq ETF or whatever other words, where you could play some of those inherently. Defense is probably a little bit more secular already, a secular trend. But there again, we've seen a massive increase, the last year or so. Now actually it's been pretty disappointing over the last couple of weeks and months already again. So you have to know if you do these more, let's say, thematic approaches, it might swing quite a bit, even more than the broader indices. But that's then, if you believe in that strategy, it's absolutely worthwhile. And we're seeing flows, especially also from retail investors. But to be fair, obviously, it's, at least for the past big providers, it's a fraction of, obviously, of the flows that we see in the bigger broad range ETF.
Yeah, but also maybe to add, I mean, uranium, it's kind of a super crazy niche. Okay, so that's not going to be really for everybody. And I wouldn't compare it at all to AI. It's not possible. I mean, just to be honest, I think all of us are underestimating this AI topic. I mean, just short term, maybe it's overpriced, but on the long term, it's crazy undervalued or kind of underthought. And I wouldn't confirm actually your point in terms of flows, because AI is still seeing a lot of interest in the market. And we see it here. I mean, just you need to have a, I would say, smart solution, because it's not that easy to invest into AI in that perspective. And actually, last year, it was one of our best-selling products at all. So I mean, just we have seen really big flows going into AI. And this year, it's not bad, to be honest. In terms of flows, yeah, the performance was not perfect, but was not it was kind of aligned to the market. Even though also this year we see kind of people coming back to this market, because it's mean reversion in terms of people have been waiting for cheaper prices in these kind of technology names, and so there is a lot of interest actually looking for this kind of exposure. And just to give you an idea, because it's really hard, how do you make it investable? AI, I mean, it's a big thing. And what we do is actually we use ourselves AI. So we use AI bots analyzing all the patterns on the background. You would need thousands of people doing that. You can do it with AI on a really scalable place. So really filtering out those companies that are going to be the future winners. Is it going to be NVIDIA? Is it going to be Meta? I'm not sure, to be honest. But we want to capture those guys who are researching right now, who are generating this pattern data on the background that could be the winners of the future. You know, coming from a direction, maybe you do not expect it as of right now. But here are very intelligent solutions in the market in the meantime. So I think this AI is going to be huge. Sorry about defense and uranium, but I think it's kind of timing topic.
Thanks for that. I'll go back to defense anyway. Andre, you have the you started the defense fund, very impressive inflows, and now you've got the European defense fund, and I'm waiting for the physically replicated defense, physically based, whatever that would be. Everybody has that, and not only defense, but you guys are quite experts in thematics, and you try different things, and so what else is there? Is the defense there to stay, or is it just a momentum that's maybe passed already? Or is there anything else out there that you see as coming as an interesting thematic exposure?
So on defense, I think if you take it as validation that it's not just us, we were one of the first to come to market when it was still a controversial topic. Now you have many big brands. I just read on the European side, we have, I think, Amundi, iShares, BNP, all following with, maybe you guys are coming with your defense as well, I don't know. Most of these larger houses they normally carefully think about whether they bring a new product or not. So let's assume that we were not all wrong, but there's a structural trend here, and they react to investor demand. I personally think there is a structural change, the way we view the world after 60, 70 years of more or less peace, at least in Europe, conflict-wise. This conflict rattled many people. This Russia-Ukraine thing that is not going away. And you see headlines like, just today, I think, the head of the Security Council, something in Russia, said, we reserve the right to use nuclear weapons if we get threatened again against Europe. Like these silly headlines, you're like, why would you need to make that threat? And it's not the first time, it's the 10th time that they make it. That leaves people a little bit scarred in their head and saying, you know what, we talk about nuclear weapons as if it's normal now. And then the US and Trump comes and says, I'm not going to defend you, like, do what the hell you want. And he's now the president of the United States. That stuff does not go past you. And then the cycles are very long for investing. So the psychological stuff is there, change in attitude, and the investments are coming now. There's 800 billion plus package from the EU in loans. You don't invest it in a short cycle. The defense cycles are fairly long, so I don't see that being a 1, 2, 3 year thing. I would hope that things normalize and something happens that brings the world back to what it was. I wouldn't mind that. I don't think it will go away that quickly. Whether it's as long-lived as AI or not, I think AI is a structural thing. That's maybe to be seen. Defense is a structural human thing, to be clear. It's always been there, conflict. So, I think it's here to stay. 2 quick ideas on other things, a bit more cheerful. Nuclear, because you mentioned it. Nuclear is very niche in Europe yet, but in the US it's actually not that niche. The partner we work with, Sprott Asset Management, they have a physical uranium trust in Canada, which is 5-6 billion. So it's pretty large. It's a physical uranium, so you can invest in the spot price of uranium. We copied that, we brought it to Europe here as well a few weeks ago. We have the uranium mining opportunity. I personally, as a real personal opinion, I think it's a really interesting tactical sector to look at if you're interested in commodity investing. It had a beautiful bull run a year ago and a bit, and then it had an equally beautiful bear run, giving up all the performance it did, almost. We think the recent correction is really not justified from a fundamental perspective. It's a lot of sentiment, a lot of correlation with other stocks. As you said, it's a very tiny sector from a market cap perspective. Very easy to short it, very easy to drive down the stock prices. So if you can survive, if you can live with volatility and you research it and you believe, yes, I agree with the structural view on it, I think from a tactical perspective, it's really interesting to look at it. And coming from that to the wider commodity market, I think commodities in general are really becoming interesting again. If you believe, or you agree that the world is transitioning to a much more electrified future, greener future, then we need to build out the networks of electricity, the behind-the-grid stuff. We're changing from a centralized energy provider system to a much more decentralized, much more solar cells, all that stuff. You need a lot of copper, a lot of metals, the new metals, and we see other providers coming with ideas to market. I speak to clients who have dedicated commodity teams now, analyst teams, who started researching that topic for the last year and a bit. And there's talks about the next super cycle maybe coming in commodities. Whether it will happen or not, honestly, I don't know. I think there's a chance for it coming, and I see people preparing for it. So, if you need ideas, maybe take a look at commodities.
It's very hard. Commodities is such a hard market to have any expectations. And I'm speaking out of my own, maybe, this experience, because I have heard peak oil already, that was I've been growing up with peak oil. We don't have it yet, so. And it comes back to the performance. Commodities are non-performing assets, and that's kind of the one thing. It's really hard maybe just to compare also to the equities. And in terms of performance, commodities for, I don't know, is it 10 years right now, haven't really been performing. Maybe let's take out gold, but overall broad multi-asset kind of commodity exposure hasn't been really performing at all. So I think it's also in terms of momentum, if momentum is going to pick up, I think there's also kind of a big trend maybe just coming up again.
I personally remember a presentation at this very conference 2 years ago promising a commodity super cycle coming. So I'm still waiting. But
these are very long cycles. They need time. Yeah.
Might be very long.
And also, just one thing to add to the AI discussion. One of the things that drove actually the nuclear discussion, which I thought was interesting, Microsoft and Amazon and so on, they're trying to build their own little modular reactors because they need very you need stable, reliable power. There was one of the reasons why actually people came back to the whole nuclear story, because again there was this shock in Europe with Russia not delivering gas to Germany, and I said, okay, if we can't rely on the gas being stable and coal is too dirty and wind is not blowing one day and there's no sunshine, what do we do at night when we need to keep our server farms running? the base load from nuclear is interesting. So if you're right with AI being a super long-term trend, maybe nuclear can benefit from that actually.
Fingers crossed. Time's running. Would be great to discuss commodities a bit more, but each panel in Poland has to touch upon crypto. But you'd be surprised. Accenture measures Polish investors' habits every year, every spring, and they estimate, and the biggest crypto exchanges don't deny it, that there's 3.5 million Polish people that are somewhat invested in crypto. Not on exchange, but in the crypto world, meaning on-chain. On the other hand, we've got close to 2 million brokerage accounts, but let's say 20–25% of that's probably the maximum that are active accounts. Yeah? So that gives you a perspective. You all provide crypto products, and then we could discuss that from the sole crypto perspective, but I think it might be a bit more interesting to look at the role of crypto, and I would, let's say 60% of the ETPs in Europe is Bitcoin, more or less, and the next 10, depending on the valuation, is probably Ether, and then there's everything else. So it's probably BTETH and more or less that. Let's see what the role of that might be in the portfolio. And I remember I was surprised by the research done by one of the sponsors of the conference, meaning Van Eck team, that they analyzed that more or less 6% of Bitcoin and ETH can improve the Sharpe ratio of your 60/40 portfolio, can almost double the Sharpe ratio. That's quite impressive. On the other hand, I read Morningstar research saying that, well, 1 or 2% or maybe 3 is probably fine, but if it's more than 10, it adds over 40% to the volatility of your portfolio. So that's quite interesting, and I was wondering, I have a different question for Andrew, by the way, but since you both offer crypto-based products, Marcus and Thomas, do you see your clients using those products as part of the portfolio management strategies? And if yes, what is the approach?
You have to differentiate maybe between the US and Europe. Okay. In the US, the acceptance of crypto ETFs has been much wider than in Europe, where we can't package those like a gold ETC. You cannot package this in a UCITS fund because you cannot sustain the diversification rules. So basically means that like gold, Bitcoin ETC is also a certificate then that's wrapped in a fund that feels like an ETF, but it's not a fund, it's an adapted instrument. So that's one reason why it's less accepted and also more difficult for, let's say, professional investors to buy it, like Polish fund of funds over here. So that's definitely one point. There's some, I guess, investors have looked at it and do think about having some structural allocation, but again, on the very, very lower end of the range you just mentioned. And for retail investors, obviously, you can go via an exchange-traded product to have the same account as your other ETFs that you might have. But of course, you can have your own wallet with the crypto broker directly. So to sum up, we see obviously it's here to stay for sure, especially with the discussion on the dollar. If it's still the world currency reserve, if it makes sense to add some Bitcoin in particular here. So these discussions are here right now, and leave it up to you to have this discussion, also maybe later on. But I think it's here to stay. But to add really in the portfolio context, it would be in the very low end of the numbers you just mentioned.
Yeah. So, Thomas, I know you started your crypto products not that long ago. I wouldn't imagine that being a significant portion of your assets under management. Does it even make sense to get into that business? Do you see that the AUM's growing, or you just did that to have it as everybody else has it? I'm teasing you a bit.
Yeah, it's a good point, actually. I mean, just to come back to your point with the back tests and kind of the optimizations, I love mathematics. You know, I'm a big fan. Mathematics is great because you can do almost everything with that. You know, so I mean, just in terms of portfolio optimization, I mean, depends on what time frame do you use. I mean, just there is a big, I would say, discussion point how much, you know, just how effective that is. But sure, I mean, if there is some product that has been performing since 10 years, like crazy numbers, sure, it's going to be good. Yeah, we don't have to discuss. And we all can agree, I think, like digital currencies are there to stay. Okay, in what manner, how does that look like? There's going to be some use cases, there's going to be some maybe visions, some ideas. So we have this offering, to be honest. The bosses expected something similar like what we have seen in the US. Like crazy inflows, crazy interest, and US has been really like, wow, I mean, just unbelievable flows. In Europe, it didn't happen. Why? Because, I mean, we have these products in Europe since 3 to 5 years on the shelf, so it's nothing really new. In the US, it was new, okay? It was
2021
new.
was the...
21?
Yeah,
okay.
when the first product
it's like
debuted on Xetra. Yeah.
4 years. Hence, I mean, just the European investors already had it, but Europe is different. So I mean, just a lot of European investors already have the wallets available. So these big companies like in Austria, like Bitpanda and so on, they have gathered a lot of market share. Okay, the ETC is kind of the solution for somebody who doesn't want to have a wallet. So we see some inflows, we see interest, but it's nothing like crazy or, I mean, just, I would be really speaking 5 minutes about, so.
Sure, thanks. So Andrea, Thomas just said that, oh, it's been performing so well, it must be a good thing. But on the other hand, it's also an asset class that can have an 80% drawdown in 2 months' time. And having said this, you just offered leveraged and inverse products on crypto. And my first question would be like, is it even legal for such a volatile asset to do it? But I guess it is. And if you could comment on how that's been going on so far, and do you see more space for similar no longer plain vanilla products based on crypto underlyings?
So to the leverage point,
it's legal, yeah.
It's legal, yeah, exactly. Oil has similar volatility to Bitcoin. It's not that much worse. Like Bitcoin came down a little bit, and not always oil. You know, in its crisis moments, in the high vol moments, oil sometimes even exceeded, was around 70-80% annualized vol. Bitcoin has 60, 50, it's coming down. It used to be at 80, 70. If you look at it over time, it comes down. So first of all, yes, Bitcoin is volatile, but it's not that there are other assets out there who are also as volatile. If people can do 2 times leveraged oil, or 3 times leveraged oil, or 3 times short oil, or 3 times long soybeans, which exist for a long time, then I think you can also do Bitcoin. It's up to everyone to make the decision. It's a tool. Nobody says you should buy it for a year. It's a tactical tool to play your view. If you believe you have a strong view on something, who am I to say that you can't do it? We're offering, you know, would I use it personally? Maybe sometimes. I speculated in Bitcoin occasionally. I used futures for that. They were even more, and I couldn't sleep well at night, and I stopped at some point because I generally had too much leverage, and it wasn't for me. Some people like that, right? It's building tools. The average investor, do you need an allocation via Delta One products? I think the Delta One products, the beta, simple beta, they will be, you know, a Bitcoin as a proxy for crypto. I think there's justification to have some in that portfolio. If you believe in the future of, you know, Bitcoin is a specific asset, blockchain is different, agree. I do believe blockchain has something to add, a value to add to technology, as a technology. I can see the value of Bitcoin. I think it lies in the eye. I think there's no, it's, when you speak to professional investors, we often have the discussion, and they say, I don't know how to value Bitcoin. I still can't give this intrinsic value to it. Do you need an intrinsic value? Do you need, you know, you said mathematics. Do you need a mathematical argumentation for that? Maybe you don't. Do you have a mathematical argument why a Picasso is worth what it is? Probably not. Is gold really worth something apart from the trust that people put into it? Supply, demand, as simple as it is. If there's enough people buying Bitcoin, more than selling, then it has value for those people. There's a limited supply in in the code of Bitcoin. And it's fine. Just like people have trust for some time in governments, if they lose the trust, actually Bitcoin is there to replace that trust and say, I trust ourselves, each other, more than a centralized power. So much about philosophizing about Bitcoin. One last point about the risk that you mentioned. If you look at the risk of Bitcoin, it's also interesting to differentiate between good and bad risk. If you look at we take standard deviation as the volatility up and down as risk. The upside risk actually of Bitcoin was often higher than the downside risk. So if you look at that, and there's a ratio, Sortino, I don't like the Sharpe ratio so much. If you look at Sortino ratio, which actually looks at the downside volatility of that, there you can even achieve even better results with cryptos, because often the volatility in crypto did not come from sudden downward spikes, which often was in equity the case, that you suddenly have deep drops and then steady up, but was actually steeper upside suddenly and then less downside. So it was actually a good volatility of sometimes a portfolio that you want. So it's not always bad just because something is very volatile.
Thanks for that. I think very, very interesting for the Polish investors to learn about. Well, I personally hope the blockchain will not replace the governments just yet, although maybe some governments wouldn't be that bad. Thanks so much. We're running out of time, but I think we may have one or two questions from the audience. If you'd like to ask something to the panelists, you have that opportunity only once a year. If you don't do it today, you will have to wait until April 2026. So we're happy to take one or two questions. No questions. Thanks so much then. I learned a lot personally. I hope you had a chance to learn a little bit as well. Please give a round of applause to my great panelists and friends of the Polish capital markets.